Short-term movements in the financial markets are essentially random. They tell us little or nothing about future returns. But there is value in looking at returns over very long periods of time. History doesn't tell us exactly how different assets will perform in the future, but studying long-term data helps us to understand the risks involved in investing in those assets and the returns they've delivered over many decades, empowering us to make better choices. Another benefit of studying financial market history is that it reminds us just how resilient capitalism or human enterprise actually is. Look at all these events that have occurred over the past century. The crash of 1929 was a devastating blow to the US economy. But there was far worse to come, a long depression and then the Second World War. Then came the Cold War, the Korean War and the Vietnam War. That was followed by the rise of global terrorism, the COVID pandemic and renewed tensions with Russia over the war in Ukraine. All of these had major short-term impacts on market prices, and yet in the long term, the market marched ahead. In his book, Mark Hebner refers to the dimensions of returns, or the types of stocks that have delivered the highest returns over time. As this chart shows, between 1928 and 2021, US stocks generally outperformed Treasury bills. Value stocks beat growth stocks, small stocks outperformed large stocks, and high profitability stocks outperformed low profitability stocks. This outperformance didn't occur over every single time period, but the reassuring thing is that the longer the period, the more likely the investor was to benefit from all of those different risk premiums. Again, there's no guarantee of outperformance in the future, but investors can and should take real comfort from long-term market data and the resilience of capitalism over time.